likewise with detachable warrants. And I guess collateral is not a vocabulary word per se, but the word debenture means debt not secured by collateral. So this was pretty much a directly or indirectly full vocabulary exam. Any questions about the quiz itself? Okay, excellent. So, just a couple of quick announcements. We have now completed our review of the textbook. I am going to review today with you a pair of different documents related to extra credit. Now let me share screen. Okay, you're now looking at my screen. If you go into Canvas, and if you go into the other folder of files, you'll see this document. Just added it early this morning, I think. And you'll see the document is named Extra Credit Activity as of 4/18/24. This weekend, when I do my usual weekend postings, weekly messages, etc., this document will be replaced by one called Extra Credit Activity as of 4/21/24. That one will show this information, and then we'll actually have the extra credit assignment described. But what I want to go over with you today are a couple of documents related to the extra credit. One about assets, that's this one up here, and one about liabilities, this one down here. When we come in on Tuesday next week, we'll have we've done it a couple times before, our double quiz. And so from 10:02 to 10:14 a.m. on Tuesday, we'll have quiz 22 about assets. Then after a 6-minute break, from 10:20 to 10:32, we'll have a 12-minute quiz about liabilities. That's what we review here. Okay, so the first quiz will be quiz 22. The second quiz will be quiz 23. Then in the last 30-40 minutes of the class, we will conclude our conversation about the extra credit. I'll have a few closing comments about the class. And then when we come in on Thursday next week, we won't actually have a class session. We will simply have a quiz number 24, on what we discussed on Tuesday. Okay, and so that's how we'll complete our 3 remaining quizzes next week. I'll cover both documents right here with you today. This first document will be quiz 22 on Tuesday. The second document will be quiz 23, also on Tuesday. And then Tuesday's conversation will be the subject of quiz 24 on Thursday. Any questions about that? Okay. As for the extra credit itself, it will be due via Canvas, and it will be due this Sunday, 11:59 p.m. This Sunday, I'm sorry, not this Sunday as in 3 days from now. I mean Sunday, 10 days from now, right? That's the end of the final week of class at 11:59 p.m. Okay. Finally, I haven't looked at the scores on the quiz that you just took, but assuming that it went okay, I'm going to assume, at least for the time being, that the recording process that we have begun is working out okay, including the process of me checking email, which I need to do under the privacy law, as we discussed. And as a result, what I'm going to do now is open my email on my iPad, okay? And I am going to record and review those two documents. Any questions? Okay, so I am beginning the recording.
Recording in
Recording is
progress.
on. Hello, everyone listening to this recording. I have a document to share with you about assets. It looks like this. I will then follow up with a document about liabilities, which looks like this. We are beyond the textbook. I want to give you a taste of what people in the real world use to reference guidance when they are not in school and don't have textbooks. They basically go online and they access for free. So instead of paying hundreds of dollars for a textbook, they get for free professional guidance from organizations like Bloomberg, major global financial information service, and PwC, which as a public service, as a Big Four public accounting firm, does publish what you can think of as a textbook for professionals. Okay. First, let's talk about assets. Now, going all the way back to our first day of class together, if you remember, I talked about accounting fundamentally being all about value, with value being defined as the value of your assets minus the value of your liabilities being the value or equity value of your company. And then over the course of the semester, we talked about different types of assets and how we have different ways of figuring out what their value is. However, there are all kinds of assets that companies own that defy our ability to describe exactly what they are. And that makes it difficult to try to figure out how to value them. I've had nonprofit clients, clients who are nonprofit organizations, say to me, someone just passed away, and in their will, they left an asset for me as a donation. And I said, great. And they said, not really. Maybe it's great, but I have no idea how to put a value on this thing. Sometimes they are oil fields and oil wells that you might say, hey, that sounds like it's worth a lot of money. Well, sometimes it is, but if there are environmental restrictions that stop you from drilling, but there are still property taxes that need to be paid, and maybe there is some concern about environmental reporting, and maybe it's in Oklahoma, and there is a tribe of indigenous peoples, Native Americans, who are suing you because they claim that the donors, person who just passed away, that his great 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 grandfather stole the property from the tribe. I mean, there's all kinds of problematic issues related to donations. But the bottom line might be, if you have an oil well, and if it's not producing oil right now, and if you have no clear idea of how much oil it's going to produce and how much it will take you to spend to get to it, how can you possibly put a value on it? Well, you may not be able to do that easily, but if it's an asset and if it has some value, you need to try. So we have three, let me see if there's an initial, okay. We have three different levels: level 1, level 2, level 3. They're called level 1, level 2, level 3, but let me refer to them as type 1, type 2, and type 3, because they're really three different types of assets. Okay, so they're called level 1, level 2, level 3, but they're really three different types or categories of assets. Now, what Bloomberg does, since Bloomberg is a global company, Bloomberg says, hey, we are going to show you what the FASB in the United States says. And that's the ASCs, the Accounting Standards Codifications of the FASB. But since Bloomberg is also a global company, Bloomberg says, we're also going to show you the International Financial Reporting Standards, IFRS. And what you'll note is the two, the FASB and the international standards, are almost exactly the same. In fact, for all intents and purposes, they are the same. They just occasionally use a slightly different term. So, what's a level 1 asset? A level 1 asset is an asset for which you can look at the thing, the asset that you're trying to put a value on, and you can go out into the market and find a price for it. Another way of saying that is you can find a price in an active market for your asset, and you can access the market, meaning you can reach out and ask the market, how much is my asset worth? You are a market that is buying and selling the asset that I own, and you should be able to tell me what my asset is worth. This provides the most reliable evidence of value. And if a market tells you, oh yes, I recognize your asset, I am trading it on my market, and its value is whatever, then you do not need to adjust the number that they are giving you. That is the value of the asset. Any questions about that? Okay, now, the additional thing to keep in mind is that both IFRS and FASB refer to the measurement date, but that's only because what they're really saying is, hey, the value of these assets can go up and down. And so just make sure that if you want to know what the value of your asset is today, that you're not using yesterday's measured value, because it might be different today. Dawn, go right ahead.
I want to clarify that part of the definition of a level 1 asset is that you do not need to adjust the price except for any issue with the date that you value the asset.
Exactly right. And so the idea is that what you are trying to put a value on is identical to, is the same asset as what is being traded on the market.
Great. Thank you.
Sure. And that gets a little bit tricky because, you know, the perfect example is if I own a share of Microsoft stock, it's literally the same share as a share of Microsoft stock that is being traded right now as we speak on the stock market. And so I can just go to the stock market and get the price and I don't need to adjust it in any way. Here's a second example. Let's say that I have a brand new collector's edition book, first edition print of some famous book. Well, there are book markets out there, including Amazon, where these books, these collector's edition books, brand new, are being traded every day. And you can go to the Amazon online marketplace and get the price every day. And if everything that is being traded, all those books, are collector's edition, first edition books, then they're all identical to each other. And they're all level 1 assets. But what if Amazon is selling first edition books? And what if I have a second edition, second publication book? Well, what if Amazon is selling first edition books in the wrapping that the book came in, never opened? Whereas I have a first edition book, but there's no more wrapping because I opened the book and I read it, and it's slightly used. Well, then, my book might still be a first edition book, but it's not identical to a never been read, wrapping has never been opened book. And therefore, it's no longer a level 1 asset. And therefore, I might say, well, maybe I can go to Amazon and find out what the price is, what the value is of a brand new, never been opened book. And maybe I can just like adjust that number down a little bit because my book is not that badly damaged. It's just been read and there's no more wrapper. Well, now you're talking about taking the value of another asset and adjusting it a bit because your asset that you're trying to value is similar to something that's being traded on an active market, but it's not quite identical. And so this adjustment needs to be made. Now you're in the world of level 2 assets. Level 2 assets mean, okay, you cannot simply find an identical asset being traded on a market at a quoted price. However, you do have some type of number for a similar asset that you can work with, or even some type of number that you can work with to guess at what your asset is worth. Okay, what kind of assets are we talking about? Well, the example that I just gave quoted prices for similar assets. A brand new book, never been opened, is similar to a slightly used book, has been opened. How about a quoted price for such assets in markets that are not active? Well, you know, there are no markets for this particular book that I own, but about once a month or so, I happen to learn that the book has been sold from one party to another party, and I can learn what it's been sold for. It's a private transaction, it's not a public market. I have to take the word of the people who engaged in that sale. But can I do that? Yeah, you can, but that would be level 2, not as good as level 1. Okay, now we're reaching. Now we're going further. What if I can find any other number that can give me insight into what my book is worth? Implied volatility means, for instance, well, my book was published 3 months ago. I know what it was worth last month, let's assume, but I don't know what it's worth this month, as in right now. But I know that between months 2 and 3, books usually lose 10% of their value. Can I say there is an implication over time that books that have been published 3 months ago, that their value has been volatile, and then on average, they go down 10% from what they were worth 2 months ago? And if you can play with these kinds of assumptions, but you're still working with numbers, that's a level 2. And then finally, this is basically a catch-all: observable data. Observable data. Okay. So that would be level 2. And as you can see, I've been working with the IFRS language. The FASB language here, just a little different. D says the same thing, but the FASB uses fewer words for D, etc. Okay, so let's review. Level 1, what I own is identical to something that is being traded on an active market. I just use the market's number to value my asset. Level 2, I can't find something identical to my asset being actively traded on the market right now. However, I can work with some numbers, and they are some numbers that I consider reliable, and I can observe what those numbers are to take a good guess at what my asset is worth. Now we go to level 3. Level 3, as you can see, the IFRS gives you very little guidance. The FASB gives you very little guidance. Why? Well, level 3 are the kinds of assets where you know they're worth something, but you have no observable inputs to try to estimate their value. What does unobservable inputs mean? I have no numbers that I can look at, that I can work with to estimate value. Well, if you don't have any numbers that you can observe, to look at, and to work with to estimate value, then how the heck can you possibly estimate value? And the answer is, you just have to take your best guess. And that is, if that makes you feel uncomfortable, it should. But it's a cardinal rule of accounting. You have an asset, and if you believe it has value, even though it might be really hard to estimate its value, you still have to try. And that is a level 3 asset. Okay, questions? Okay, Don, I think you have your hand up from the earlier question. Oh, there we go. Okay. Okay. And that concludes my review of how to value difficult to value assets. Please do make sure that you can understand the difference between level 1, level 2, level 3, because that will be the subject matter on quiz 22 next week. Okay, how about quiz 23? Now we're bopping over into liabilities. What you see here is a 909 page PwC publication. It's basically PwC's comprehensive textbook. Why is it 909 pages? Well, what PwC basically does is it writes a principles level textbook, and then it writes an intermediate level textbook, and then it writes an advanced accounting level textbook. And if you take what is essentially a triple textbook and put it together in one gigantic PDF document, it's a compendium of all financial accounting standards. This is what you get. Now, there are 3 specific clauses or sections in the textbook that I'm going to cover with you. And they all relate to contingent liabilities, which we actually did cover in class. In fact, we just took a quiz on it, I guess, a quiz or 2 ago. Okay, now if you remember the quiz on those contingent liabilities, I think it was in the same chapter as short-term liabilities, basically said that if the probability of paying the liability was remote, don't worry about it. If the probability of paying the liability was the opposite of remote, pretty much probable, and if you could estimate the liability, then you have to accrue it, book a journal entry for it, and disclose it on your financial statements. And then there was this middle category where it was somewhere in between, and you were told, okay, if it's somewhere in between, then you don't need to record it as a journal entry, but you still need to discuss it or disclose it on your financial statements. And so PwC says that in chapter 23 of its gigantic textbook. Here is the table of contents. See, chapter 1, introduction, chapter 2, balance sheet, chapter 3, income statement, chapter 4, other comprehensive income, the unusual income statement, 5, stockholders' equity, and it just keeps going and going and going. Chapter 23 includes contingent liabilities and other types of liabilities. And I'm going to take us down to 23.4.2. Okay. $23.4.2. Let's see. 23. Okay, we're getting there. 0.4. There we go. So, contingencies. If you are uncertain as to whether or not you're going to have to make a payment, that's a contingent liability or a contingent loss. Well, then, as we discussed, if you will probably have to make the payment, and if you can estimate reasonably what the payment will be, then you have to record the liability. Coming back here, let's go to 23.4.2. That would be this little paragraph. And what I want you to do is just sit back and think about how PwC's version of what a textbook should be like is different than what McGraw-Hill thinks a textbook should be like. Because if you think about it, based on what we just said, this is basically no different than a textbook. A textbook and PwC have both said, well, okay, if it's probable that I will have to pay money to someone, and if I can estimate how much that will likely be, then that should be recorded as a liability. But what PwC does in this professional guidance is give you practical insight into how to apply that to normal situations. And so here's a normal situation. Legal costs, the costs of your lawyer. What if somebody is suing you and you know you're going to have to spend a lot of money on a lawyer, whether you win the case or you lose the case? When you accrue, when you record a contingent liability to account for the fact that you might lose, in addition to recording as a liability the damages you will pay, do you have to also accrue the money that you will have to spend on your lawyers? Well, PwC is actually quite straightforward. Some people believe yes. Others contend no. You don't put the legal fees that you think you will have to pay to defend yourself into that liability. It should not be recognized as part of a loss contingency. So according to PwC, the answer is maybe yes, maybe no. Well, if a CPA says, well, then how do I make a decision? PwC concludes by saying, make any decision that you think is appropriate for you. Just be consistent. Don't change your mind all over the place, and do disclose it. Let people know what you are doing. Okay. Questions about that? Dawn, go right ahead.
Okay, so when consistently applied, okay, so does that mean in regard to that specific situation? Or could you make this decision based on, I mean, hopefully they're not having a lot of these, but let's say, you know, there were. Should the consistently applied be specific to each situation, or that's how the company deals with it, period?
The best consistency is a consistency where you can say, this is how the company deals with it, period. And I should add, most big companies do have multiple lawsuits at the same time. So for instance, right now, Amazon is not only dealing with one lawsuit from someone who is angry with Amazon because, and I'm just making this up, let's say someone right now, I'm sure this is the case, someone out there is suing Amazon because its delivery person placed the package on their front steps and someone came along and stole the package, and now Amazon is being sued for not putting the package down in a secure manner. If there's, for any large company, if there's one lawsuit like that, there are several, or perhaps even many like that. It's inevitable. And so consistently applied ideally means I have one way of doing this for the entire company, period. Okay, so that's 23.4.2, and that's fairly straightforward, but what PwC does is build upon that. And now let's make that a little bit more complicated. So let's go to 23.4.3, which introduces the concept of the rebuttable presumption. Okay, what is a rebuttable presumption? The word presumption means I am allowed to assume something to be true simply because it sounds reasonable. But the word rebuttable means if you show me evidence that my belief is not true, I owe it to you to look at the evidence, and I am required to change my mind if appropriate. Now, that's different than just being objective and keeping an open mind to begin with. Rebuttable presumptions say, no, you don't have to have a perfectly objective open mind to begin with. You can presume that one of your choices is the true one, is the best one, but you still have to be open to someone who will rebut or dispute your presumption by showing you evidence to the contrary. That's what a rebuttable presumption means. And so in this case, what PwC is, it's true that if you're going to lose money, at least you think you're probably going to lose money on a lawsuit against you. Well, that would be a contingent liability. You would have to record that as a liability. Okay, what if you say, aha, I have an insurance policy. If I lose the lawsuit, the insurance company is supposed to reimburse me for my loss. Well, in that case, you have a liability if you think you will probably lose the case. But then you have an asset or a receivable, insurance receivable, if you think you will probably get the money back from the insurance company. Okay, what if the person who is suing you, or you yourself when you file the claim, what if that process is subject to dispute or litigation? Well, then, there is a rebuttable presumption that recoverability of the claim is not probable. So what does that mean? That means that if you say to the insurance company, I think I'm going to lose this lawsuit, let me start to file my claim so that you can reimburse me, because that's what insurance is all about. If the insurance company says, I don't think I should have to pay your claim, maybe you have been reckless. and I don't have to pay claims from reckless people. Well, if the insurance company disputes your claim, then the initial presumption is that you're probably not going to get the money from the insurance company. Now, if you are filing that insurance claim, and if your auditor says to you, my presumption is that you're probably not going to get money on the insurance claim because look, the insurance company is disputing it. Well, the client can still provide you with evidence. No, I think I can force the insurance company to pay me, and therefore an insurance company receivable is still appropriate. Well, if that evidence is persuasive, then the auditor might say, okay, company, go ahead and record an insurance claim receivable. But my presumption as your auditor is that as long as I see the insurance company disputing your claim, my presumption, unless you persuade me otherwise, is that you're not going to get the payment from the insurance company. And therefore, there is no receivable asset. Any questions about that? Okay, furthermore, what if you think that the insurance company is going to pay you more than your loss? If the potential recovery on the insurance claim exceeds the amount that you actually lost to begin with, does that mean that you are recognizing a gain or revenue because your liability is going up by what you will have to pay the person who is suing you, but your receivable is going to go up, an asset is going to go up by what the insurance company will pay you? Is it possible that what you will get from the insurance company exceeds your loss? Sure. And if an asset is going up by more than a liability, is that revenue? Is that a gain? Absolutely. If it sounds a little dubious that the insurance company will pay you more than your loss, it's not that the insurance company wants to do it. It's just that when you filed your claim, you started claiming that you lost all kinds of property that you actually didn't lose. You know, suddenly your house burns down and you file your insurance claim, or your car gets stolen and you file an insurance claim, and suddenly you say, oh, in my car that was just stolen, in the back seat or the trunk, I happened to be carrying expensive computer equipment. Well, if you were just goosing up the claim to get more money out of the insurance company, if you really did not have any computer equipment in your car when it was stolen, the insurance payment, the receivable, could be more than the liability, the loss. Moving on. An asset, however, should not be recognized for a claim from a party that asserts there is no liability. Okay, this is getting really weird, but let me explain what this means. And they mention that this is usually in the area of environmental liabilities. So, what happens if I am an oil company and I am involved in an oil spill. And people who live locally who become inundated with crude oil that I have spilled sue me. Well, I might have an environmental liability. And if I have an insurance policy, I might file a claim and have an insurance receivable asset. Maybe time goes by and I'm still fighting the case in court because I don't want to pay the liability. But I'm still carrying forward my claim. And maybe at a certain point in time, if I think it's likely that I might have to pay the liability, I can get the insurance company to pay the claim. What if I get the money from the insurance company and I settle the lawsuit? So I get the money from the insurance company and use it to pay the people who are suing me. But let's say the day after that happens, I find out that the people that were suing me didn't actually live close to the site of the oil spill. Well, then I might say, technically, the people that were suing me were not directly impacted by the spill. Aha, I have a loophole. I might be able to go to court and demand that the people who sued me, who I paid, give me my money back. Is it possible that I might get money out of the insurance company for this environmental spill? And at the end of the period, I might not actually pay the liability because I might be able to get my money back on a technicality? And the answer is, it's highly unusual, but it could happen. It is so highly unusual that you might be able to get a claim paid to you by the insurance company while you can avoid using their money to pay someone who is suing you. That is so unusual that there should be a rebuttable presumption that the asset will never be received, meaning the insurance company will never actually pay you that cash and will not let you keep it. However, it is a rebuttable presumption, meaning your auditor is going to say, should say, I am assuming or presuming that your insurance company is never going to let you keep cash on a claim they pay for you if you don't have to pay the people who are suing you. However, like every rebuttable presumption, if you show me evidence that this is a special case, I'm willing to change my mind. Okay, questions on that? Okay, one more point. Insurance recoverable. We have an asset, insurance receivable. We have a liability, lawsuit liability. If we lose the court case, we will receive cash on the insurance receivable, on the claim, and use the cash to pay off the liability. If at a moment in time you have that receivable on your books and that liability on your books, and if those two numbers are equal to each other, do I just offset them? and show neither one on my balance sheet? Or should I show the asset and the liability? Receivable due from insurance company, liability due to person who is suing me. Do I show the asset and the liability separately on my balance sheet? And the answer here is don't offset them, show them separately, because the asset really is an asset and the liability really is an obligation. And just because you're going to use the asset to pay off the liability does not mean that they don't both exist. And then finally, we have this final point. Sometimes the insurance company says to you, if you lose the court case, I, the insurance company, will pay the party who is suing you directly. And so you're not actually going to get the cash payment from me, the insurance company, and you're not actually going to pay the party who is suing you the cash. If you lose, I, the insurer, will pay the party who is suing directly. Well, if I'm not actually handling the cash, then does that mean that I have no asset and no liability? And the answer is no, of course not. The fact that the insurance company might say, I'll just pay the plaintiff directly is just an administrative convenience. You still have the right to expect them to pay. That is an asset. And you still have a liability to make sure that the plaintiff gets paid. And so that's your liability. My point here is that when it comes to contingent liabilities in general, what we learned from the textbook is that if you're being sued, or if for some other reason, you might have to pay somebody some money, even if you're not sure you'll have to pay them, if you think you probably will, and if you can estimate how much you'll probably need to pay them, then you should record the liability. And that's what we learned earlier this semester from the textbook. What you get out of this professional guidance, which takes the place of a textbook in the real world, is that is true. But the details do get trickier. Example number one, if you have to pay a lawyer, whether or not you win or lose the case, then are those legal costs part of your liability? And the answer is people disagree. Whatever you decide to do, be consistent. Practical issue number two, okay, let's say that I'm not just going to pay the money, I'm expecting to get reimbursed from an insurance company. Well, if the amount that I will get from the insurance company will be used in total to pay whatever I have to pay, is there still a liability? And the answer is yes. And there is an asset too. Okay, is it possible if I goose up the, over exaggerate my claim a little bit, that the asset, the receivable, will exceed the liability? Absolutely. Well, then don't I have a gain or revenue from a lawsuit that I'm thinking of as a bad thing, but might be a good thing if I can goose up the insurance claim and make money, yeah, that's certainly possible. Do I have to be concerned that the insurance company is going to dispute their need, their obligation to pay me? Yeah, you do. You always do. And if they do dispute the payment, then your auditor will probably look at you and say, you can show me evidence to the contrary, which I will review, but my presumption, which you may rebut, is that if you're dealing with a insurance company that is disputing your claim, you're probably not going to get paid anytime soon. And finally, what if you have your asset and your receivable? Can you net them together for your balance sheet? No, you cannot. And even if you say, hey, I'm not even going to get paid any money, I'm not actually going to pay anybody any money, the insurance company might make the payment. Does that mean that I can avoid booking the asset and the liability? The answer is no. This is pragmatic, business-oriented guidance, the type that you don't find in any textbook, that gets added on top of the general textbook guidance in material like this. Okay, questions, comments, thoughts, suggestions. Dawn, go right ahead.
Okay, so when it comes to the term rebuttable presumption, what we need to know for quiz purposes is that if you have a claim and the insurance company might not want to pay because they feel like you were negligent, you have a rebuttable presumption with the
Right.
insurance company. Is
So,
that
so what happens is most of the time, the accountant is supposed to be objective and dispassionate and is not supposed to assume or presume anything, and is supposed to simply look at the evidence and make his or her mind up. However, there are some times here and there in the accounting standards where the accountant is told, given this particular situation, your initial inclination is to assume or presume something, even though you still have to be open to argument, right? And alternative information. And so you are supposed to make a presumption, although someone can rebut it. And that's the situation that we find in this particular area, where if an insurance company tells you, I'm sorry, I am disputing the appropriateness of your claim, I have no intention of paying it, then the presumption is you don't get the money, that there is no receivable. Although if you really think you have a right to fight for it, we can evaluate what you say.
got you? So the insurance company was an example of the rebuttable presumption.
Exactly.
Gotcha.
Exactly.
Great.
Exactly.
Thank you.
Sure. Sure. Other questions? And again, questions, comments, thoughts, suggestions. Lawson, go right ahead.
I'm still confused on like the last part that we covered. That like we said the insurance recoverables, I think, was this part that we're on right now.
Mm-hmm. Yeah.
Don't really understand because it's like reporting entries often manage risk by purchasing insurance. Generally, amounts received under the insurance contract should not be offset against the reporting entities. And then
Right. So hold on. So let me jump in with an example. Let's say that you hire me to mow your lawn and I overmow, and so I kill the grass. And you say, you killed my grass, I am suing you for $500 because that's the cost of new seed that I have to put down to get the grass to grow again. So you're suing me for $500. I have corporate liability insurance. And so I go to my insurance company and file a $500 claim. And I say to the insurance company, look, I'm going to fight the lawsuit. We're going to court. I don't know that I'm going to lose. I hope I'm going to win. And let's just say, for the sake of argument, that I expect to win. But I am filing this claim with you because I have an insurance contract with you. I bought the contract, I'm paying you a premium, and you're supposed to reimburse me the $500 should I lose the case and have to pay it to the homeowner. The question is, okay, I might have to pay $500. That's a liability of $500. If I do, then I might get the money. I expect to get the money from the insurance company. Well, that's a $500 asset because it's receivable from insurance company. Well, if the $500 asset receivable from insurance company is related to the same transaction as the $500 legal liability, then many accountants say, why don't I net the asset against the liability and show neither one on my balance sheet? And PwC is coming down very strongly on the idea that no, you want to show the asset and the liability separately because they might be separate. Your insurance company might say, you were negligent. I'm not going to pay you anything. And the receivable may not exist, but you still have to pay the person who's suing you, so the liability still exists. That's what they mean by this particular paragraph here. Okay, Lawson, was that helpful? Yeah, go ahead.
That means that there would be two separate transactions, that there would be one for the asset and one for the liability then.
Exactly, exactly. And that also actually makes it easier to account for situations where you are beefing up your claim so that the claim is actually higher than the loss, which again, there are legal concerns about doing that, but it doesn't obviate the fact that people do it a lot and get away with it. And so if you lose $500, but if you beef up your claim and claim that you lose 600, you can wind up getting 600 from the insurance company and only pay 500. And so by having the asset and the liability separate, it does confirm that these are related to each other, but they're not the same. Okay, make sense? Awesome.
Yes, it does.
Great. Other questions, comments, thoughts? Okay, I'm going to make just a quick comment, and then I'll do my going once, going twice deal, and then we'll call it a day. Final comment about this. The most famous case of all time where the insurance receivable was disputed by the insurance company, and the party that suffered the loss wound up having to make a massive payment. It was a massive loss, and the insurance company did not cover it in full. On 9/11, when the Twin Towers were destroyed, I think each tower was worth $100 billion. And so the owner of the Twin Towers went to the insurance company and said, I am about to file the biggest property insurance claim in history. I just lost two $100 billion towers. And so please pay me in a cashier's check, $200 billion, please. That's my claim. And the insurance company said, well, you know how insurance companies are. First, they say, I just want to say I'm so sorry for your loss. You know, I feel your pain. If there's anything that I can do to make things better, please let me know. And of course, the owner said, just give me my $200 billion, please, so I can use the money to start rebuilding the Twin Towers. And so little time went by, and then the insurance company sent the cash. And the owner of the Twin Towers called the insurance company and said, I don't understand. I was expecting $200 billion from you. What you sent me was $100 billion. Why? And the insurance company replied, because when I looked at precisely how the insurance policy was worded, the insurance policy had a little clause that I, the insurance company, put in that said, because each tower is worth 100 billion, the maximum loss that this insurance company will pay on any loss event is 100 billion. And the owner of the towers said, yeah, that's right. One plane hit the North Tower. That was an event. I lost 100 billion. Another plane hit the South Tower. That was another event. I lost another 100 billion. So you owe me 200 billion. You only paid me half of that. The insurance company replied, no, it was not two different events. The attack was coordinated. It was a single event. And the maximum payment on any single event is only 100 billion. And of course, the owner said, but I wasn't interpreting that to mean that when I signed this insurance policy. And the insurance company said, the way that you interpreted it is your problem. As long as I say, as the insurance company, that my position is, this was a single event, not two events. You suffered a single coordinated loss, not two losses, even though I am saying that they were twin towers, there were two of them. Then I only owe you $100 billion, not 200 billion. Well, if you remember, you may not remember, of course, but you may know that for the first 10 years or so, nothing was built on the Twin Tower site. It was just an open pit. And then suddenly, within a couple of years, the one tower, they never rebuilt twin towers, they built a single tower, went up quickly. Well, if you're curious, why was nothing built for 10 years? And then suddenly, within a couple of years, a tower was built, but only one. It was because this court case took 10 years to settle. And at the end of 10 years, the courts finally decided the insurance company was right. And so the owner of the Twin Towers, which actually at that point was just an open pit in the ground, looked at his $100 billion check and said, this is only half of what I need to rebuild the Twin Towers. So do I take this money, which is only half of what I need to rebuild Twin Towers? do I rebuild one big tower? Or do I build two half towers? And he probably would have had more valuable real estate by building two half towers, because there were and still are a lot of people who are afraid of renting property all the way at the top of the Twin Towers. But the owner of what was the towers said, I just can't. I can't build two stubby little towers where the Twin Towers once stood. But I can't afford to build two Twin Towers with half the money. And so I will build one major tower. And so that was a case, maybe the most famous case in my lifetime at least, where the receivable from the insurance company and the liability of the loss were not the same at all. Although in that particular case, the asset, the receivable, what they actually got from the insurer, was precisely 1/2 of the liability. Okay, final questions, thoughts? Yeah. I'm sorry to end on such a gloomy note, but it is a true story. And with that, let me stop recording.
Recording stopped.
The link to my recordings will always appear on the home page of Canvas. So right now, if you click on that link, you will see my recording from 2 days ago. But as of this Saturday, which is when I do my uploads of all the new information, as of this Saturday, when you click on the link, hopefully, if the video recorded well, you will see today's recording. So use the same link and you will see whatever the latest recording is. Okay, and with that, any final comments or questions? Going once? Going twice? Lawson, go right ahead.
So what we just did, when will we find out about